The Federal Reserve just made a big announcement. This news has sent ripples through the financial markets and has everyone talking. The decision is monumental and will have far-reaching consequences for the economy. They're hitting the brakes on interest rate cuts. This move comes as a surprise to many who were expecting a different approach. The Fed's stance indicates a shift in their strategy, focusing more on long-term stability rather than short-term gains. This is a big deal for all of us. Whether you're a homeowner, a business owner, or an investor, this decision will impact your financial plans. The ripple effects will be felt across various sectors, from real estate to the stock market. It affects everything from mortgages to stock prices. Higher interest rates mean higher borrowing costs, which can slow down economic activity. On the flip side, it can also mean better returns for savers and investors in fixed income securities. Remember back in 2022 and 2023? The economic landscape was vastly different. The Fed raised rates like crazy to fight inflation, which was spiraling out of control at the time. The Fed raised rates like crazy to fight inflation. Those were turbulent times, with the economy facing unprecedented challenges. The aggressive rate hikes were a necessary measure to bring inflation under control. Now, they're saying those high rates are here to stay. This is a clear indication that the Fed is committed to maintaining a tight monetary policy. They believe that keeping rates high is essential to ensure long-term economic stability, at least for 2025. This means that businesses and consumers alike will need to adapt to a new normal. Planning for the future just got a lot more complicated. This news sent shockwaves through the financial world. Markets reacted swiftly, with stocks experiencing significant volatility. Investors are now reassessing their strategies in light of this new information. Investors were caught off guard. Many had been betting on rate cuts, expecting the Fed to ease monetary policy. This unexpected decision has forced them to rethink their positions and make quick adjustments. They were betting on rate cuts. The sudden shift in the Fed's policy has left them scrambling to adjust their portfolios. The uncertainty in the market is palpable, and everyone is trying to make sense of the new landscape. Now, they're scrambling to adjust their portfolios. Financial advisors are working overtime to provide guidance to their clients. The focus is now on finding safe havens and minimizing risks in an unpredictable environment. The Fed's decision is a clear signal. They're serious about taming inflation. This move underscores their commitment to achieving price stability, even if it means making tough choices that could slow down economic growth. They're serious about taming inflation. The message is clear. The Fed will do whatever it takes to keep inflation in check. This includes maintaining high interest rates for an extended period, even if it means slowing down the economy. The impact of this decision will be felt across the board. From small businesses to large corporations, everyone will need to navigate this challenging economic landscape. The Fed's decision wasn't made lightly. Three main factors are driving their caution. First, inflation is stickier than expected. Prices are still rising faster than the Fed would like. They're aiming for a 2% target. We're not there yet. Second, the job market is still red hot. Unemployment is near record lows. This is great news for workers, but it also puts upward pressure on wages and prices. Third, the global economy is still uncertain. The war in Ukraine, supply chain disruptions, and energy price volatility all pose risks. The Fed wants to keep some ammunition in reserve in case things take a turn for the worse. The stock market didn't like the Fed's announcement one bit. The Federal Reserve's decision to keep interest rates steady rather than cutting them sent shockwaves through Wall Street. Investors had been eagerly anticipating a rate cut, which they believed would provide a much-needed boost to corporate profits and, consequently, stock prices. The disappointment was palpable as traders and analysts quickly adjusted their strategies in response to the unexpected news. The major indices, like the S&P 500 and the Nasdaq, tumbled on the news. The S&P 500, a broad measure of the market, saw a significant drop, reflecting widespread concern among investors. Similarly, the tech-heavy Nasdaq experienced a sharp decline as technology stocks, which are particularly sensitive to interest rate changes, took a hit. The red graphs and falling charts were a stark visual representation of the market's immediate reaction. Investors were hoping for rate cuts to boost corporate profits and stock prices. Many had positioned their portfolios in anticipation of a more favorable interest rate environment. The lack of a rate cut meant that borrowing costs would remain higher, potentially squeezing profit margins for companies and making it more expensive for consumers to finance big-ticket purchases. This led to a wave of concern and recalibration among market participants. Bond yields, on the other hand, rose. This is a typical reaction when the Fed signals that interest rates will stay the same or increase. Higher bond yields can attract investors looking for safer returns compared to the more volatile stock market. The rise in bond yields was a clear indication that investors were seeking refuge in fixed-income securities amid the uncertainty. When interest rates rise, bond yields tend to follow suit. This is because investors demand higher returns to compensate for the increased risk of holding bonds in a rising rate environment. The relationship between interest rates and bond yields is a fundamental concept in finance, and it plays a crucial role in how different asset classes perform in response to monetary policy decisions. This is because investors demand higher returns to compensate for the increased risk of holding bonds in a rising rate environment. As bond yields increase, the prices of existing bonds typically fall, which can lead to losses for bondholders. However, new bonds issued at higher yields can become more attractive to investors, creating a dynamic and often complex market environment. The market reaction was swift and dramatic. Traders on the floor moved quickly to execute orders, and the stock market ticker showed rapid changes as prices fluctuated. The initial shock of the Fed's announcement led to a flurry of activity, with some investors selling off stocks to cut their losses, while others saw potential buying opportunities amid the volatility. But it's important to remember that markets are often volatile in the short term. While the immediate reaction to the Fed's decision was negative, it's crucial to take a longer-term perspective. Market volatility can create opportunities for savvy investors who are able to navigate the ups and downs. Over time, the market tends to stabilize as investors digest the news and adjust their expectations accordingly. The Fed's decision is just one piece of a complex economic puzzle. Other factors, such as corporate earnings, geopolitical events, and economic data, also play significant roles in shaping market trends. Understanding the broader context is essential for making informed investment decisions. While the Fed's actions can have a profound impact, they are just one of many elements that influence the financial markets. The Fed's decision has real-world implications for all of us. When the Federal Reserve makes a move, it sends ripples through the entire economy, affecting everything from the stock market to the interest rates on your savings account. It's not just a headline, it's something that can impact your daily life and financial well-being. Whether you're an investor, a home buyer, or a saver, understanding the potential impact is crucial. Each group faces unique challenges and opportunities in this changing financial landscape. By staying informed, you can make better decisions that align with your financial goals and needs. For investors, it means a period of uncertainty. The stock market often reacts unpredictably to changes in interest rates, leading to increased volatility. This can be nerve-wracking, but it's also a time when savvy investors can find opportunities. Keeping a close eye on market trends and being prepared to act quickly can make a significant difference. Stock market volatility is likely to persist. This means that prices can swing dramatically in a short period, creating both risks and opportunities. It's essential to stay calm and avoid making impulsive decisions based on short-term market movements. Instead, focus on your long-term investment strategy. It's more important than ever to have a well-diversified portfolio and a long-term investment horizon. Diversification helps spread risk across different asset classes, reducing the impact of any single investment's poor performance. A long-term perspective allows you to ride out market fluctuations and benefit from the overall growth of the market. For homebuyers, it means higher mortgage rates. As interest rates rise, the cost of borrowing increases, making it more expensive to finance a home purchase. This can affect your buying power and the overall affordability of homes in your desired area. If you're thinking about buying a home, be prepared to factor in higher borrowing costs. It's essential to budget carefully and consider how higher mortgage payments will fit into your overall financial plan. You may need to adjust your expectations or look for ways to save on other expenses. It might also be prudent to shop around for the best mortgage rates and terms. Different lenders offer varying rates and conditions, so taking the time to compare options can save you a significant amount of money over the life of your loan. Don't hesitate to negotiate with lenders to get the best possible deal. For savers, it's a glimmer of good news. Higher interest rates mean that the money you have in savings accounts and certificates of deposit will earn more interest. This can help your savings grow faster, providing a bit of relief in an otherwise challenging economic environment. Higher interest rates mean you'll earn more on your savings accounts and certificates of deposit. This is particularly beneficial for those who rely on interest income, such as retirees. It's a good time to review your savings strategy and consider locking in higher rates with longer-term deposits if you don't need immediate access to your funds. While it's not a reason to celebrate, it's a small silver lining in an otherwise challenging environment. By staying informed and proactive, you can navigate these changes more effectively and make decisions that support your financial well-being. Remember, the key is to stay calm, stay informed, and stay focused on your long-term goals. Section 5. Investors, stay calm and carry on. I know it's scary to see the market drop, but, panic selling is the worst thing you can do. Remember, you only lose money in the stock market if you sell at a loss. Now is the time to review your portfolio. Make sure you're diversified. Don't have all your eggs in one basket. Focus on quality companies. Look for businesses with strong earnings and solid balance sheets. They're better equipped to weather economic storms. And most importantly, stay the course. This isn't the time to abandon your long-term investment strategy. Section 6. Homebuyers, don't panic, plan ahead. Yes, mortgage rates are going up, but don't let that derail your dream of home ownership. Start by getting your finances in order. Save for a larger down payment. This will lower your monthly mortgage payments. Shop around for the best mortgage rates. Don't just settle for the first offer you get. 0.25% difference in interest rates can save you thousands of dollars over the life of your loan. Consider all your options. If you can't afford your dream home right now, maybe start with a smaller starter home. You can always upgrade later. Section 7. Savers, a glimmer of hope in a low-yield world. Finally, some good news for savers. With interest rates rising, you can finally earn a little something on your cash. Shop around for the best rates on savings accounts and certificates of deposit. Many online banks offer higher yields than traditional brick-and-mortar banks. Consider a high-yield savings account. These accounts typically offer higher interest rates than traditional savings accounts. Just be sure to read the fine print and understand any fees or restrictions. Section 8. Riding the economic roller coaster. The economy is like a roller coaster. There are ups and downs. Right now, we're on a bit of a downward slope. The Fed's decision is a reminder that we're not out of the woods yet. Inflation is still a concern, and the global economy is still fragile. But don't despair. The economy is cyclical. What goes down must come up. The key is to be prepared for whatever comes our way. Section 9. Remember, this too shall pass. I know it's tough right now, but remember, this too shall pass. We've been through tough times before, and we've always come out stronger on the other side. Focus on what you can control. Manage your finances wisely. Invest for the long term, and don't be afraid to ask for help if you need it. We're all in this together, and together, we'll get through it.